So we are on week 13. Thank you for completing the survey earlier. Uh, I updated the dates on the announcements. Some of the dates were from the prior semester. I updated everything now. It should say December. We're in the 13th week. We have 2 more weeks, next week and the week after. So we have class next week. Then the week after that is when all your work is due. Okay. So we are meeting one more time next week, another Zoom session. So we're having another lecture like this during our Zoom session. The last week, the week of the 15th, I'm going to give you guys time to complete and submit your final presentation, as well as all your other projects. I will also review the final presentation, the requirements as well, next week. If you're not clear, I posted a video on how to do it, or the announcements, explanation. Just watch it. Shows you what to do. There's another video on the announcements that tells you how to do the actual project. I show you where to find the answers, how to research the answers roughly. That's all on the announcements. So you don't have to sit there struggling, how do I find these answers? If you actually download the document with the questions on it in bullet point form, I give you tips, and in the video I show you how to do that. So you just got to do the work. So this week is about accounting and financial information. So this is allowing you to essentially take a look at a business's financial statements, allows you to understand, summarize, classify the financial transactions, the financial events concordant to the business or the body of the business. You know, some of you may be taking or will be taking accounting courses uh, at BMCC. The accounting courses you're taking is teaching you how to do bookkeeping, accounting, bookkeeping as an accountant. Financial statements in particular, when you're working as a business owner, you're managing a profit and loss center as a manager or upper manager or middle manager, district manager, territory manager, whatever it is different. Okay. So the accounting you're going to be learning, like accounting one and accounting two, it's different. That's literally like a bookkeeping. Okay. The accounting you learn for actually doing strategic decisioning, like strategic financial decisioning, that's called a financial statement. The financial statement includes the income statement, which is which is how much money you made, how much money you lost. It also includes your balance sheet, which is predominantly the inventory you own, the things you own, the things the business owns, and the statement of cash flow, which is actually looking at the flow of cash coming back and forth in the business. The reason why you have that third statement, the statement of cash flow, is because certain transactions that you are deducting as expense for the business or cost for the business, they're not real transactions, right? So mainly taxes, depreciation, which is the reduction in value of something you own. So if you buy a truck for the business, the moment you drive that truck off the wherever you purchased it, if you bought a new truck, the moment you buy that truck, it loses value. Any car you buy loses value. Anytime you buy an iPhone for your business, you spend $1,200 to buy an iPhone. You open up that packaging, you turn the iPhone, is now used. It doesn't resell for $1,200 anymore. It's going to resell for less. That's depreciation, loss of value. So that no cash came in and out of your hand. It's a fake loss, but it's a real loss. So when you do the financial statements, you can write off the value of an item you have to pay less tax. So a business could say, we're losing money. right? We're losing money left and right. And then you look and the reality is that they're writing off all these deductions from maybe something they did 3 years ago, right? They're writing off depreciation, loss of value, tax credits, and then they're saying, "Oh, we lost money this year," and then they didn't really lose money. They just had all these deductions that they wrote off that allowed them take to pay less taxes, claim less income. That's what Amazon done. Amazon billion, zillion, billion, multi-billion dollar business barely pays tax because of how they manipulate the accounting system. Okay. So for you, when you learn accounting, it should be exciting from a business standpoint, but the intro accounting is all bookkeeping, right? It's not until you learn financial statements and then you start to learn, you learn financial statements and then you learn, it's not even an accounting class necessarily, but it is an accounting class. It's more of like a finance class. It's considered like a finance course on the accounting side. Once you learn that, and then you start to learn higher levels of forensic accounting, which you need to be doing an undergraduate degree, a master's degree. Forensic accounting really figures. How does Amazon pay no tax, right? There's you forensic accounting. You need to really know how to game the system, so to speak. That's the useful stuff. You learn that later, unfortunately. So what you learn initially is just basic bookkeeping. You unless you're an accountant doing taxes or something or doing accounting bookkeeping for a client, it's not practical. You're not going to use it, but it's sort of foundational. All right. The financial statement stuff is practical. So let's take a look and see what they're going over here, right? So they're going over inputs, processing, outputs. You see accounting documents, records, processing. These are journals and entries you put in to log that information. And then this data here, which is sort of like accounting 101, then gets translated into the financial statements. This is actually what's important for you to make decisions on as a business, as a manager, as an owner, the financial statements. So that's what's more relative. Okay, so users of account information, the required reports, tax documents, government regulatory agencies, things of that sort. Bookkeeping is what I mentioned about record keeping. This is sort of like where you start, which you'll probably learn during your first counting course is just how to do basic record keeping. As a business owner, all of this done virtually. You use software to do it. You can even link your bank accounts to software and it'll crawl into your bank accounts and it'll itemize everything for you. No one does this by hand anymore. You could, you'll learn how to do it, but it's all automated. Analyzing the financial statement is not an automated process. You have to actually understand what you're looking at to dissect it. So that's where the brain, you have to use your brain to figure things out. Okay, so this is steps in the accounting cycle. You'll see the things, this first three parts is the bookkeeping. The last parts here, the final steps over here is the financial statement steps, balance sheet, income statement, statement of cash flow. This is actually the relevant material. This is sort of the bookkeeping process. So bookkeepers tools, ledgers, trial balance. This is all very standard business accounting 101 stuff. Again, unless you're an accountant, you're not going to really use that as from a business standpoint. You're just looking at the financial statements. That's what your main objective is. But obviously, know the definitions for your examination. These are different Intuit, QuickBooks, things you can use to do your taxes, to do accounting. We reviewed financial statements already. I reviewed that with you guys. So this is important though, right? Your fundamental accounting equation. Your liabilities and your owner's equity equals your assets. So assets is what you own. Now I'll go over this little detail. So let's say I own a truck. All right. Let's say the truck is worth $100,000. I may or may not have bought the truck all cash. Let's say I financed it with a loan. So let's say I used $50,000 to buy the truck, and I took out an auto loan to finance the other 50,000. So I purchased $100,000 truck, 50,000 out of my own pocket, 50,000 out of the bank's pocket. Okay. So the total value of the asset, which you see here, is the truck, which is $100,000 because that's what it's worth. It's equal to the liabilities and my owner's equity. So the owner's equity is what I put down to buy the truck, 50,000, because that's what I own. That's my equity. Equity is what you own in something. So 50,000 owner's equity, liability is what I'm liable for. So I'm liable to pay back a debt to the bank for 50,000. So that's my liability. Liabilities is usually credit card debt, loans, things you owe. So if you look at what you owe, 50,000, and you add it to what you own, which is 50,000, it comes out to the total value of the asset, which is the truck for 100,000. 50,000 plus 50,000 is 100,000. So that's the basic fundamental accounting equation. You're looking at everything you own, everything you owe. You add them up, and that's your total value of your assets. That would actually go. That would physically go under your balance sheet. That's where that goes. Okay. So that's how that equation works. Okay. So right here, balance sheet, that's where it goes. So you have assets, liquidity. So assets are things you own. Liquidity is cash, right? Any type of cash product or something that can be converted to cash, usually less than a year, or less than 1 year's time from a financial planning definition is considered liquid. Realistically, if you're running a business, you want something you can convert to cash in less than under 30 days. Realistically, because you could buy a building and sell it in under a year. It's not liquid. A property is not considered liquid, but you can list a property in September and then sell it in October and have your cash in January. You could flip and sell something in under 6 months, but it's not liquid, right? So realistically, the definition of liquidity is something that can be converted to cash or is cash pretty much the near term, almost immediately. So you could take your stocks and your bonds in your portfolio, your E-Trade account or whatever, you could sell tomorrow. You might sell a loss and lose a ton of money. That sucks. So is that liquid or not liquid? It's liquid, but it doesn't have the functionality of maintaining value at the time of liquidity. So the only true liquid thing you can depend on to remain stable is cash in all scenarios. Cash-like equivalents like treasury bills, T-bills, have some instability. They could lose value or gain value. You can liquidate them tomorrow in your brokerage account and get the money, right? So liquidity here isn't also factoring in volatility because assets have volatility. That's important. Some assets have no volatility, some have more volatility. You want to sell your car, it's not worth what it was yesterday. You want to sell your stocks and bonds, it's definitely going to change in value every minute. It's changing in value. The house, the property, your equipment, it changes in value, right? So, like for example, my dad bought some when he was like in the 80s. He's a big computer guy, so he had all these computers, and they lose value. The computers lose value because they become outdated and old, right? So it says low megabytes, low processing power. people want the new stuff. But all the stuff you bought back in the 80s it's now 50 years old. It's collector's items. Amiga, old stuff. People collect it. So it has renewed value because it's considered collector's items and its stuff works. So as an asset is worth junk because when it came out in the 80s, it was the hot stuff. And then it became worthless. And now it's hot again because it's a collector's item, right? So it's arbitrary. There's volatility inherent into the asset. And different asset classes have different levels of volatility, meaning changes in value. That impacts your liquidity. So you'll see here current assets, fixed assets, and tangible assets. As a business owner, understanding the volatility of your liquidity of your assets determines how much actual true liquidity you have on hand when it comes to making this strategic decisions. Okay. So owner's equity is what you own. Retained earnings is an earning from a firm from your company's profitability and operations that were reinvested back in the business. So I'll give you a quick example. If my business makes $100,000 for the year, I may reinvest 20,000 back into the business next year. All right. I may take 80, reinvest back 20, use that 20 to buy some stuff for the business next year. That's called retained earnings. Okay. We went over income statement. Shows your profits, shows your company's profits, expenses, and taxes. Also shows if you have a net income or net loss. Usually it's as after-tax loss, after-tax gains. All right, this is the equation. The income statement is your revenue minus your goods that you sold, the cost of it. So let's say you're selling hamburgers and hot dogs. That's going to be the cost of your hamburgers and hot dogs, right? Subtract that from I sell a hot dog for $2. It costs me $1 to make the hot dog. Gross profit's $1, right? And you minus the cost of your operating expenses, which is going to be your lights, your utilities, to pay the guy, to cook the hot dog, to flip the hot dog. Let's say that's 50 cents per dog. My net income before taxes is 50 cents. Taxes, maybe Uncle Sam takes a third of it. So now I'm making 30 cents on a dog. All right. So my net income is 30 cents per dog, hot dog. So that's the breakdown of the income statement. Revenue is the cash you're making from your goods and services sold. Cost of goods sold is a measure of the cost of merchandise sold or cost of raw materials used for production for resale. Okay, so that has to do with the actual cost of the good to make it. What is that sold? So, like I said, the hamburger, the hot dog, if it costs you $1 to make it, you're selling it for $2. You don't sell it for $1. You don't make any money, right? So cost of goods sold. So if you look at the equation above, is revenue minus cost of goods sold. So that's the cost of what it costs you to create the product or service, cost of goods sold, right? And then what's left over is the profit margin. So just to reiterate, I sell a hot dog for $2 in revenue. It costs $1 in buns and hot dogs. So $2 is what I sell minus the $1 of the actual dog and the bread and the fixins. It gives me a gross profit of $1. So that's how that works. So kind of common sense, right? But that's the definition of it. Operating expense is everything you need to operate the business: rent, utilities, salaries. Depreciation is, I went over that before, writing off taxes and the decrease in value of your asset prices. What's left over is in net profit. Okay. Statement of cash flow is similar to financial statement, but is looking at actual cash, the actual flow of cash. So looking at your operations, your investments, and your financing. Okay. So taxes, for example, depreciation you wouldn't see on the statement of cash flow as it would show on the income statement, because depreciation is no actual cash. It's you writing something off, losing value artificially. So you wouldn't see that in the statement of cash flow. Ratio analysis is just ratios that you would use to sort of figure out relationships between different financial statements, financial aspects, liquidity, your how much debt you have, which is your leverage, your profitability, things of that sort. So liquidity ratios is current assets that assets you have that can turn to cash. Leverage is there's the debt that you borrow, the ratios of how much money you have versus what you borrowed is showing you if the company is really in a lot of debt or not. That's important to understand. Company could be profitable. They have a lot of credit card bills. That's important to know, right? You could be making $1 million a year, but you could owe $10 million, right? So you're showing a profit of $1 million, but you owe a lot of money. You could have another company that owes nothing, no debt, but they're losing money every year. So what's the better company? The one that owes a lot but makes profit, or the one that has no profit but owes nothing, right? So, or the better one is the business that has lots of money that is making and owes nothing. That's the best one. Because that business you can then borrow more money from to leverage to then do a buyout or something. Private equity firms look at these numbers to make decisions on what type of business to buy and how they can manipulate the business to make more money. So they're looking at these ratios to make those decisions. That's why it's important. Private equity firms, for lack of a better word, they flip businesses. You heard of flipping houses? Private equity firms flip businesses. Okay, so you can buy a house, fix it up, flip it, sell it. That's private equity. That's what they do for me. They'll buy a business, fix it up, flip it. They may do some other stuff to make value. They may combine other businesses together into one massive business, create efficiencies between those businesses, and create new value. That's what a private equity firm does. It's the business flippers, just like the house fixer-upper flippers. This is the business side. So this is the math. This is the science they're using to figure it out. They're looking at the balance sheets. They're looking at the income statements. They're looking at the cash flows. They're looking at the ratios. They're looking at the debt. They're looking at the income, the net income, the expenses, and they're figuring out the business to then see what they can do with the business. Okay, the strategies. They're looking at all the business strategies we spoke about earlier. They're looking at the market. They're looking at the research, and they're figuring things out. Everything you're learning in Intro to Business, guys, that's all you need to know. You got to learn the details, obviously, but it's all fundamental. Strategically, math wise, everything is introductory. Then you kind of go into the details of the income statement, right? So then you learn the higher levels of income statement, balance sheet, financial statements, because then you learn the how to read the business. So this stuff is low level, but it's high level. You just don't know yet how to make sense of it to be high level, but it's not really that high level. You could take a financial statement course for free from SBA. As an entrepreneur, you can learn it for free. You could find a free course. So the knowledge is there for you to learn on your own. You don't always have to pay for it. You just have to know where to find it. So financial accounting, there's an annual report, teaches you how to the annual report helps you find information about the business, all the financial documents. I'm not going to get into that too much. Auditing is important. Your business will get audited tax-wise to make sure you're not cooking the books or doing anything funny and lying, to prevent you from paying taxes. So accounting is important because it lets you understand what's going on with your business. It also prevents you from getting in trouble with the IRS, so you pay the right amount of taxes. But just remember the definitions. That's what's really important for your exams. So, guys, I'm going to end this part of the lecture now. Be mindful to finish the survey, and you have your final exam coming up. Should be available for you actually next week. Actually, it's available now. We'll meet again one more time next week. So I'll see you then, and take care.